You put money in a savings account thinking it's safe. But the second it lands, your bank lends it out and makes 50 times more than they'll ever pay you. Today, I'm going to show you exactly how that works.
Every time you deposit money into your savings account, you probably think it's just sitting there, safe and sound, waiting for you. But the truth is, the moment your money hits that account, your bank puts it to work, and they make a lot more from it than you ever will. Today, we're going to break down exactly how banks profit from your savings account, and why the system is designed to keep you earning pennies while they earn billions. Let's start with the basics. When you open a savings account and deposit money, the bank doesn't just lock it in a vault. That's a common misconception. In reality, banks are only required to keep a small fraction of your deposit on hand. The rest? They lend it out. This is called fractional reserve banking, and it's the foundation of how modern banks operate. For every $100 you deposit, the bank might keep just $10 in reserve and lend out the other $90. That $90 earns interest for the bank, at rates far higher than what they pay you. Here's where the real money is. The difference between what a bank charges borrowers and what it pays depositors is called the net interest margin. Right now, the average savings account pays around 0.5% interest. But when banks lend that money out as mortgages, car loans, or credit cards, they're charging anywhere from 5 to 25% interest. Let's put that in perspective. You deposit $10,000 into your savings account. At 0.5%, you earn about $50 a year. But the bank takes that same money and lends it out at 7% on a mortgage. That's $700 in interest income for the bank, from your money. They pay you $50 and keep $650. That's a 13-to-1 return in their favor. But lending is just the beginning. Banks also invest your deposits in government bonds, treasury securities, and other financial instruments. These investments are considered low risk, but they still generate returns of 3 to 5%, far more than what the bank pays you. Large banks manage hundreds of billions in deposits. Even a small spread of 2 or 3% across that volume generates enormous profits. J.P. Morgan Chase, for example, reported over $80 billion in net interest income in a single year. That money comes primarily from the gap between what they earn on loans and investments versus what they pay depositors like you. Now you might be wondering, why don't banks just pay higher interest rates? The answer is simple. They don't have to. Most people don't shop around for better savings rates. They open an account at whatever bank is convenient and never think about it again. Banks know this, and they exploit that inertia. The big four banks in America, J.P. Morgan Chase, Bank of America, Wells Fargo, and Citibank, consistently offer some of the lowest savings rates in the industry. Meanwhile, online banks and credit unions often offer rates 5 to 10 times higher. But because most people stick with what they know, the big banks have no incentive to compete on rates. There's another way banks profit that most people never think about. Fees. Overdraft fees, monthly maintenance fees, minimum balance fees, wire transfer fees. The average American pays over $100 a year in bank fees alone. In 2023, U.S. banks collected over $5.8 billion just from overdraft and insufficient funds fees. These fees act as a hidden tax on your savings. Even if your account earns a small amount of interest, fees can easily wipe out those gains and then some. The bank profits whether your balance goes up or down. Let's talk about something even more concerning. Inflation. If your savings account pays 0.5% interest, but inflation is running at 3%, your money is actually losing purchasing power every single year. That means the longer your money sits in a traditional savings account, the less it can actually buy. The bank is making money from your deposits while the real value of your savings slowly erodes. This is what financial experts call a negative real return. Your account balance might go up slightly, but your buying power goes down. It's like running on a treadmill. You feel like you're moving, but you're staying in the same place, or worse, falling behind. So what can you do about it? First, move your savings to a high-yield savings account. Online banks like Ally, Marcus, or SoFi regularly offer rates of 4 to 5%, which is 8 to 10 times what traditional banks pay. Your money is still FDIC insured up to $250,000, so there's no additional risk. Second, consider alternatives for money you won't need for a while. Treasury bills, certificates of deposit, and money market funds can all offer better returns than a basic savings account. The key is to stop letting your bank profit from your financial inertia. Third, audit your bank fees. Switch to accounts with no monthly fees and no minimum balance requirements. Many online banks offer these for free. Every dollar you save on fees is a dollar that stays in your pocket instead of the bank's. Here is the bottom line. Banks are businesses, and your savings account is one of their most profitable products, not because of what they give you, but because of what they take. The spread between what they earn and what they pay you is pure profit, multiplied across millions of accounts and hundreds of billions of dollars. Understanding this doesn't mean you should avoid banks entirely. It means you should be strategic. Make your money work for you the same way banks make it work for them. Shop around, demand better rates, and never let your savings sit idle in a low-interest account.
Now you know the game. Your savings account isn't a favor from the bank. It's one of their most profitable products. If you want more breakdowns like this, subscribe to Money Mechanics. We'll see you in the next one.